So when you talk a conspiracy and reality, sure, fine line, but why would 8 banks from the West have the largest concentrated short position in this stupid, archaic relic that no one needs, that being silver? Why would the silver price, when it's coming out of the ground at a 7-to-1 ratio, ask Keith Neumeyer, he'll tell you that, 7-to-1, meaning 7 ounces of gold for every 1 ounce of silver. It's now priced at roughly 100-to-1, coming out of the ground at 7-to-1. Why would these 8 Western banks hold these large concentrated short positions, which is as dumb as a mud wall in this environment? Why would they do that? Well, because the military industrial complex needs it to make cheap weapons. And that's my belief. I think silver is definitely a play worth holding, but it's more speculative ultimately in terms of its performance.
Silver, once considered merely a monetary relic or speculative play, is now re-emerging as a critical asset in both industrial and strategic spheres. Its unique properties make it indispensable in various technologies, from solar panels and electric vehicles to advanced weaponry and aerospace systems. While gold has traditionally been the favored safe haven asset in times of uncertainty, silver offers a rare combination, a store of value with expanding industrial demand. Silver continues to represent tangible wealth in regions where trust in fiat currencies is eroding. Yet, despite its growing importance and shrinking availability, its market price remains conspicuously low, prompting increasing scrutiny from analysts and industry insiders. According to Andy Schectman, president of Miles Franklin Precious Metals, this disconnect may lie in deliberate market interference. Institutions such as JP Morgan and BlackRock are alleged to hold some of the largest concentrated short positions in silver's history on the COMEX exchange, an anomaly that, in Schectman's view, cannot be separated from broader strategic interests. These same entities also serve as custodians for silver-backed ETFs, like SLV, raising questions about potential conflicts of interest. Schectman and other market observers argue that the same financial players who dominate the paper silver market are also directly or indirectly aligned with defense and government-linked industries that benefit from a low silver price. The growing disparity between silver's geological rarity and trading price adds to the concern. Silver is mined at roughly 7 ounces for every ounce of gold, yet it is priced at a ratio nearing 100-to-1. Far beyond the historical average of about 45-to-1. For Schectman, this signals a systemic undervaluation driven not by natural market forces, but by financial manipulation. The price could undergo a rapid revaluation if the market could correct itself, due to physical shortages, geopolitical shifts, or a breakdown in confidence in paper silver products. Analysts estimate that silver could reach between $75 and $400 per ounce in a freely functioning market. Such a shift would not only reward long-term holders, but could also reset silver's place in the global economy as a vital strategic asset in an era increasingly defined by resource security and technological competition. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think that's the most important thing to take away. So they've been doing it, with whatever means they have, a lot of it in the black market because of import duties and whatnot. But the more wealthy they become, 100%, they'll just continue to accumulate. To them, that is wealth. To a large portion of the world, gold and silver represent wealth. And I think people need to not look at it as an investment. You don't buy gold to become or silver to become wealthy. Now, silver offers that potential. I do believe that. I have a take on silver that, and say what you want about it, but I believe the military industrial complex has been shorting silver for years. They need it in high-tech weaponry. They used to be quoted in the supply-demand numbers, and the military is gone. And I gave a speech at Vancouver Resource Investment Conference where I said there's 500 ounces of silver in a cruise missile. A guy comes up to me 3 years ago and he says, I work for the Department of Defense. I almost fell over. And he says, I helped design the Tomahawk and I know there's silver in it. I'll get back to you. Never hear from him again. I see him the next year, 2 years ago. He says, I'll be damned. There's between 13 and 15 kilos in a typical cruise missile, Tomahawk or Patriot. He says, you were right. And then I've gotten to know him, and it's in all sorts of high-tech aerospace and weaponry. And So who owns all the military contractors? Well, that's largely BlackRock. Who's the custodian of SLV? Well, that's BlackRock and JP Morgan and also GLD. And so what happens is they step on the price of silver. Don't believe me? There's 8 commercial banks that hold the largest concentrated short position of any commodity ever traded in the history of the COMEX market. Guess what it's in? Yeah, it's in silver. And then you see the trading 3.5 times annual global mine supply, 10 times the float in London on silver by commercial banks. They hold the paper price down. They build high-tech weapons. They take it out of the supply-demand numbers. Even though we're running structural deficits, they pull it out. But they need it to make the weapons to fund wars all around the world. Then places like the Ukraine get blown up. And who gets the reconstruction contracts? Oh, that's right. It's BlackRock. So when you talk a conspiracy and reality, sure, fine line. But why would 8 banks from the West have the largest concentrated short position in this stupid, archaic relic that no one needs, that being silver? Why would the silver price, when it's coming out of the ground at a 7-to-1 ratio, ask Keith Neumeyer, he'll tell you that, 7-to-1, meaning 7 ounces of gold for every 1 ounce of silver. It's now priced at roughly 100-to-1, coming out of the ground at 7-to-1. Why would these 8 Western banks hold these large concentrated short positions, which is as dumb as a mud wall in this environment? Why would they do that? Well, because the military industrial complex needs it to make cheap weapons. And that's my belief, and I will take that to the grave with me. And the only way that that gets beaten is by the rest of the world saying, aha, like China, we see what you're doing. You're suppressing the price to accumulate it for whatever the reason. But guess what? We're just as rich as you are. And we're going to do the same thing. In fact, we're going to pile on the short side with you, and we're going to stand for delivery. And at some point, the rubber will meet the road. And that is kind of, you could argue, a little microcosm of what you saw yesterday in the platinum market, where bang, up 7%. It's a short squeeze. So it doesn't mean it will continue, but that is a microcosm of what you will expect whenever you manipulate markets in this degree. They always end badly. Manipulations always end badly. You can only manipulate a market for an extended period of time by pushing it in the direction it's going. And forever, no one wanted these commodities and certainly wouldn't stand for delivery. They wanted our stocks, our bonds, our real estate, because we had trust. We don't have trust anymore. Now, as Zoltan Pozar says, we're moving to Bretton Woods 3, a system about transparency and commodities, a la blockchain and commodities. And they're going to rush to get the commodities. But instead of just throwing the kitchen sink at it, they have to do it slowly and methodically, or they cut off their nose to spite their face. Let it be volatile. Let it be volatile. Let it go up and then go way down, and everyone turns away and walks the other way. And then they stand for delivery, and they keep buying, and they let it go up, and then they smash it, and they stand for delivery. And this has been going on. It's accelerating. So yeah, I think we haven't seen anything yet. And silver is, to me, the most asymmetrical investment on the planet, low downside, high upside. And if it were really set free, if you just took the 150-year price average of, call it 45-to-1, with gold at 33.15 divided by 45, right now, it should be minimum of $73. That's what 150 years worth of average price. You take that same 33.15 and divide it by 7, you're at 473. Now, if you told me silver was at 473 tomorrow, I'd say, oh, that kind of makes sense. That's a 7-to-1 ratio between its geologic footprint right now. It was 16-to-1, which was its geologic footprint for 5,000 years. I remember being in the industry when the Dow Jones was 2,100 in 1989, and they said the first conference I went to, the guy said it's going to go to 10,000. They laughed him off the stage. Here we are at 40,000. So the point of it is that markets go higher than people think possible. And when you manipulate it, like interest rates were manipulated, they may go higher than people think. And asset prices may fall lower in the face of rising interest rates because of that manipulation. And the same thing is true here with silver and gold. You hold it back for that long in the face of massive global demand in an asset that is diminishing and depleting in nature. I did an interview with Rick Rule. He said 18%, just 18% of the silver that was mined last year or came to market last year came from primary silver miners. Right. The rest was byproduct and recycling. It's disappearing. So yeah, I think silver is definitely a play worth holding, but it's more speculative ultimately in terms of its performance.
Gold is experiencing unprecedented physical demand, with May seeing over a 700% increase in gold deliveries on the COMEX compared to the previous year. Over 16,000 contracts, each representing 100 ounces of gold, were delivered, totaling more than $5.3 billion, marking the largest monthly delivery in the exchange's history. According to industry expert Andy Schectman, this surge is driven by major institutions, possibly including the U.S. Treasury, accumulating physical gold as a strategic hedge amid growing economic uncertainty. This strong demand has shown remarkable resilience, with gold prices quickly rebounding after temporary drops, highlighting investor confidence in gold's long-term value. Global interest is also rising, with countries like China increasing their gold purchases to multi-month highs, signaling a broad shift toward precious metals as safe havens. Andy Schectman and other market analysts suggest this surge in physical gold reflects more than just typical market fluctuations. There are indications that bullion banks and government entities are working in concert to repatriate gold reserves and manage supply, potentially paving the way for a new monetary system that includes gold-backed treasury debt. This view is supported by insights from financial insiders like Vince Lanci, who believes these coordinated efforts could fundamentally reshape gold's role in the global economy. Schectman notes that such strategic accumulation goes beyond reactions to tariffs or short-term factors and points toward a structural shift that may lead to a significant revaluation of gold, positioning it as a key pillar in future economic stability and monetary policy. Let's get back to the interview.
Just in the month of May, Adam, we've seen a 700% spike in gold delivery from last year, same time, and which is May's usually a quiet month for gold. We've seen the largest delivery in the history of the COMEX market. Last I looked, it was over 16,000 contracts at 100 ounces apiece. People are institutions, whoever the heck it is, U.S. government, Treasury itself, I don't know. They're standing for delivery at a level nobody has ever witnessed before. 16,000 contracts, Adam, is $5.3 billion worth of gold.
Wow.
The largest delivery in the history of the COMEX market, not just in gold, but also in silver too. So there's a huge demand for physical holding of gold and silver. And you look at, the gold price that gets knocked down by $200, $100 for 2 days in a row nearly, and it shoots right back up. That's strength and resilience that I have never seen in 35 years. To me, the physical demand is overwhelming the paper price. And this is, I was reading something on X the other day, a comment, if you will, between Vince Lanci and Luke Groman. And, Luke said, now imagine what happens if it was the U.S. government bringing back that gold. And the response to all the commercial banks, because they were basically saying that it almost looked like a sell-only market, that they were a coordinated fashion, that they got together with the managed money and said, this is about to blow up the whole market. There is no more buying allowed, only sell only. And that's what he was intimating. And he says, in response to the above from the U.S. government is FU, he says, send us more gold next month too, and more behind for July, August, and September. And Vince Lanci says, it was, Luke, it was. No ifs, ands, or buts. Bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself, it most certainly was. Now, these are two of the smartest guys in the world. And basically what they're saying is that it's the U.S. government bringing all this gold back in. And if you look month over month over month over month, in fact, let me, if you don't mind, just share one thing with you.
Absolutely.
This is just the month over month increase since last year. If you can see that, COMEX gold delivery. This is not something that is just an outlier in 1 month. Month over month over month over month over month. And really, this goes back to November, where we are. I would just simply say the biggest money in the world has been using any sign of weakness to stand for delivery and to accumulate more, and the price keeps going higher and higher and higher. It's not just here. You look at what's happening even in China too, and the numbers are off the charts in China. I think they bought the amount of gold that they just bought was an 11-month high this last month. So yeah, I think the best of what we could expect to see in gold prices is still, and silver is still way in front of us. I don't know it off the top of my head, but I would think it would be minuscule at best.
Like single digits, 10%?
Not even. I mean, maybe
okay.
even the other way. Probably the other way, if I had to guess. And net exporter would be my guess, because the previous administration had no affinity to bringing gold into the COMEX, certainly. So it would have only been trader based. This is something different, and this really happened since November of 2024. So I don't know for sure. But if I were betting in Vegas, I would say it was almost inverse of what we're seeing here. Certainly not what we're seeing on this chart. So I don't know, but I would be way different than it is here.
So basically, we're seeing a very marked increase year over year, and that increase keeps gaining month over month so far this year.
Correct.
Just for folks that would say, hey, Andy, you can't really look at the May and April numbers because they're so polluted by people trying to front run tariffs and stuff like that. What would your answer be?
That this has nothing to do with tariffs. The conventional wisdom was that it was tariffs and arbitrage. Okay, there's a little bit of that. That's fine. But this is far different. That's the cover, if you ask me. And, you put it in context, for example, with President Trump's tweet on Easter Sunday, the golden rule of negotiating, he who has the gold makes the rules. Really, that's interesting. You put it in context with Treasury Secretary Bessent, who is a self-proclaimed gold bug, by the way, and whose largest holding in his last job running a hedge fund was in gold, that there would be a new monetary system implemented within this administration, a new Bretton Woods, he said. So, when you put all of these things together, you've done an interview with Judy Shelton. We've talked about that, her idea of backing treasuries with gold. She told me, I don't know if she told you, but she told me flat out that Trump told her that he would issue gold-backed treasuries on July 4th next year. The 250th.
I did not hear that. That's actually really interesting. Okay.
Which is the 250th year anniversary of the country. She told me that he told her that. Now, what does that mean? Maybe he changes his mind, but she's a very bright lady and more or less says that that's what she was hedging at. And so I think that there's something far more important happening with gold, And, you talk about like the smash in these markets. Well, the silver smash, 60 million ounces of silver on paper were dumped in 1 hour last week when the price got smashed. It's a sign of desperation, maybe to cover physically. I don't know, because here we are, the silver price is right back up. And I just think that this is something far different than the media is portraying. Certainly it's a lot more than tariffs. That I would bet just about anything against.
The continued artificial suppression of silver prices faces growing pressure as global demand for physical silver intensifies across key industrial and technological sectors. Entities that have maintained large, concentrated short positions to keep silver prices low may struggle as tangible consumption, especially from emerging green technologies and defense applications, continues to outstrip supply. Meanwhile, increasing accumulation by institutions and governments steadily depletes available inventories, creating a widening gap between market supply and real-world demand. This imbalance is likely to make ongoing price manipulation more difficult to sustain over time. The silver market may experience a sharp and substantial price correction as these suppression tactics weaken. A rush to cover short positions could trigger a rapid increase in silver's value, amplified by persistent industrial requirements and strategic stockpiling of physical metal. This shift would reflect a new reality where silver's price aligns more closely with its critical role in technology and limited availability. For investors, this could signal the beginning of a strong upward trend, positioning silver as both a vital industrial commodity and a compelling store of value in the years to come. That's it for today. Share your thoughts on Andy's analysis in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.